We continue on our journey exploring tax strategies relating to charitable giving. And to get the gist of how these strategies work, it is critical to understand the interplay between the standard deduction and itemized deductions. But to set the stage, I would be remiss not to hit on above the line deductions, and we'll answer the question, are there any above the line charitable deductions? Above the line deductions appear on Schedule 1, Part 2 of Form 1040 under Adjustments to Income. Some examples of current above the line deductions include unreimbursed expenses for educators who work in schools, business expenses of reservists, performing artists, and fee-based government officials, contributions to a health savings account, moving expenses for members of the armed forces, the deductible part of self-employment tax, contributions to self-employed SEP, simple IRAs, and qualified retirement plans, health insurance premiums for self-employed people, alimony payments, contributions to a traditional IRA, and student loan interest, among others. There are a number of them, but what is noticeably missing, at least currently, are any above-the-line charitable contribution deductions. Charitable gifts are not above the line currently. Not long ago, during COVID, the federal government offered additional tax benefits for charitable contributions by allowing limited charitable gifts to be taken as above-the-line deductions, thereby reducing adjusted gross income. Above-the-line deductions are great, and they can have a real impact beyond just lowering your tax bill. And they can be taken whether or not you take the standard deduction, which we'll discuss in just a moment. But unfortunately, as we will explore further, what we'll find, because charitable deductions are currently below the line, you only get the benefit of reducing taxable income if you itemize deductions. Now, why itemize versus take the standard deduction? Taxpayers have a choice, and it really is just a simple math problem. So first, let's dive deeper into the standard deduction by looking directly at the IRS website. The standard deduction is a specific dollar amount that reduces the amount of income on which you are taxed. In general, the standard deduction is adjusted each year for inflation and varies according to your filing status, whether you're 65 or older and or blind, and whether another taxpayer can claim you as a dependent. The standard deduction isn't available to certain taxpayers. You can't take the standard deduction if you itemize your deductions. To give you an idea, in 2024, the standard deduction for married couples filing jointly is $29,200. Standard deduction for single taxpayers and married individuals filing separately is $14,600, and the standard deduction for heads of household is $21,900. Itemized deductions appear on Schedule A of Form 1040. This is the form for 2023. Some other examples of itemized deductions include medical and dental expenses, taxes that you paid, so state and local taxes, interest that was paid on a home mortgage, gifts to charity starting in Section 11, casualty and theft losses, and other itemized deductions that appear in the list in the instructions. You would only itemize deductions if the total amount of your itemized deductions exceed the current standard deduction. To determine whether this makes sense, you just tally up the total amount of your itemized deductions, you compare it to the current standard deduction, and you'll have your answer. Now, this matters a lot in the context of charitable giving because it means that your charitable contribution will have no tax effect, no effect on your taxable income unless you itemize. To say this differently, if the total amount of your itemized deductions are less than the standard deduction, you cannot take a deduction for your charitable contributions. But if your total itemized deductions exceed the standard deduction, then you're into the territory where your charitable contributions will start to have the tax effect of reducing your taxable income. Now, this seems like bad news for charitable-minded individuals who usually take the standard deduction. But we are just getting started, and I assure you that all hope is not lost for tax planning with charitable gifts. Even if you often take the standard deduction, which many people do, we'll cover ways to increase the probability that your charitable giving will receive preferential tax treatment. So stay tuned for the rest of the episodes in this series, because this is where it starts to get very interesting. This is where the planning strategies really start to take off, many of which are designed to overcome the limitations that we just discussed. So this is only the beginning. And now that we have a basic understanding of the tax rules that currently exist, we can take a look at some of the ways to plan around them. Now, for those who do itemize, let's take a look at where gifts are reported on Form 1040. You'll note here that the form quickly directs you to further instruction, which I'll just show you for reference. It's just really important to keep in mind that if you are taking a charitable contribution deduction, that you read the instructions and make sure that you're in compliance. So one thing to note, for example, for contributions over $250, you must have a written acknowledgement from the charity reflecting your contribution. The instructions show you the specific requirements for that written acknowledgement. There's some other strict guidelines to be aware of here, so you'll want to make sure that you're paying attention, especially if you're going to make significant contributions, because there may be limits on how much of your contributions you may deduct. We're going to cover this in future episodes in this series, but for now, I just want to reiterate that if you are charitable minded, but you do not have enough to itemize, we're going to explore some other strategies, including gifting highly appreciated assets to avoid capital gains tax. We'll talk about bunching. We'll talk about donor advised funds and qualified charitable distributions, or QCDs. So whether or not you would ordinarily take the standard deduction, you can still take advantage of tax planning strategies for charitable giving. And some of them may be far easier than you think. So please be sure to follow along throughout this series, and we will look forward to seeing you in the next episode.